Hey folks, welcome back to the channel. Going live a little bit early today because I'm having some connection issues. Not sure that everything is going to work, but I did want to start off with the headline today that was on Yahoo Finance. JPMorgan expects a Category 1 economic hurricane in 2023. This is not actually the bad news that it sounds like. Okay. I don't know if you guys remember, but back in June, Jamie Dimon warned us that there was going to be basically the bottom dropping out of the economy. It was going to be economic Armageddon. Well, that assessment seems to be changing over there at JP Morgan. On Wednesday, JP Morgan economists Michael Ferroli and Daniel Silver wrote that they see the US in a mild recession in the second half of 2023 as the Fed looks to complete its mission to flatten inflation. So, this is kind of the pathway forward that JP Morgan sees with the Fed is that the next interest rate hike is going to be 50 basis points. And we're probably going to see 25 basis points in January and again in February. And then that's when we see the pause. Now, why does the recession happen after that? Well, there's a lot of institutional inertia when it comes to the economy, and it's going to take a while for that to set in, for that increased cost of capital to really affect the market. I mean, it's already affecting the market, don't get me wrong, but it's going to affect the market quite a bit more. Not just the market, but I'm talking about the economy in general. And we're going to see a slowdown at that point. Now, does that warrant panicking in your portfolio? Well, the time to panic would have been several months ago. Not that I'm a panicker. I've stayed invested this entire time. I've done, other than reduce the amount of leverage that I have in my account, meaning I've reduced the amount of stock that I have on margin. I haven't done any liquidations of my core portfolio apart from Neo. Neo was the only thing that I started to liquidate back in June and July, and it took me till about October to do so. But anyway, that wasn't done because of the recession that we're going in. It's really a matter of reducing my geopolitical risk when it comes to China. China is still an exciting market. I just don't know how much exposure I want to it. And you get a lot of exposure to China if you own Tesla stock and if you own a number of other stocks on the S&P 500. So that's one of the things. But this is actually good news that JP Morgan is predicting a hurricane, but at this point, it's only a Category 1 hurricane rather than what they were predicting, which is basically a Category 5 back in June. So um, let me see what is there anything else in this article that I wanted to cut. Honestly, that would bring the federal funds rate near 5%, a level of financial tightening that most economists think would certainly push the U.S. economy into recession. So essentially, they want about 1.7 million jobs to evaporate. That's kind of their stated goal at this point. So, yeah. Anyway, there are going to be opportunities abound out there. Michael Will says, I like Goldman Sachs. They've crashed the share price of lithium stocks. Time to pick up more LIT ETF, methinks. So LIT is one of my holdings. It's one of my core holdings. And I've covered this on my channel before, like LIT and BATT. Those are two ETFs that are concentrated on the lithium battery supply chain. And I think that's a good bet on the EV industry. So at some point, we have to start talking about Tesla, right? And whether or not they're really going to lead this revolution going into the future, right? And the reason I wanted to start taking a look at Tesla and having kind of a frank and honest conversation about how much we should be putting into Tesla is for a couple of different reasons. Number one, they're not in an environment anymore where they don't have any competition. The competition that's out there right now is really starting to produce some pretty good vehicles. Like, I don't know if you guys saw the Consumer Reports article that went out, I think yesterday or the day before, where it talked about EV reliability. Now, the headline was kind of misleading, where they said that electric cars are kind of pretty low on the scale when it comes to reliability, but they ranked pretty much exactly as high as full-size trucks that are produced, which are the best-selling vehicles in the United States. By the F-150 is the best-selling vehicle, and it's pretty much all the other really large trucks behind that basically comprise a huge portion of the U.S. vehicle market. Well, they're not very reliable. They score on a reliability index. They score just about as high as Tesla does overall as a company. The Model 3 tested very well, I think with a reliability index of something like 73 or something like that. Don't quote me if I don't know if that's exact, but it was actually the Kia EV6 that tested. Was it the Kia EV6? Whatever the EV6 is, that's the one that tested the highest in terms of reliability. So uh, that was kind of a things I should be looking at too is all of the days of recession. And we're starting to see a couple of people buck the trend, not just JPMorgan, but we're also seeing Goldman Sachs kind of buck the trend now. Saying chance of a recession is only about 35% next year. That's below the consensus forecast of about 65%. And it's all based on data. The immediate reason is that the incoming activity data are nowhere close to recessionary. What they're really talking about is GDP growth and, of course, employment. And as GDP is raised by 23, that would be not exciting by any means, but it would definitely not be recessionary. And a little bit here, and I wonder people getting a little bit too excited over 1 month of data that says that inflation is slowing. I would like to see a little more data come out before I kind of make a decision about EV stocks that are out there. I don't want to address the Twitter Elon Musk debacle. I wish that he would just stop tweeting. That would be better. And I think that Elon Musk's plans to pull back on being the CEO and be, or not his plans, but his desire to pull back on being the CEO of Tesla and to become the sort of product may actually play into his strengths a little bit better. He is a better visionary and deliverer of products than he is a CEO of a large corporation like that. And I really think that this Twitter thing, there's got to be a plan in there that we're not seeing right now that isn't immediately obvious. But I don't see a way of him creating a platform that is profitable, that doesn't rely on advertising. And like I said, maybe there's a different way of monetizing that content like they do on YouTube. That's been discussed. But that's one of the things I wanted to just briefly touch on here before I stop talking about Twitter for the next couple of months. All right. Okay. Big news here in EVs that are not named Tesla. GM's EV unit BrightDrop expects $1 billion in 2023 revenue. Mass production of all-electric delivery vans to start in December. So that's actually pretty interesting. So they say the driving factor behind this, of course, is the 30% tax credit for commercial EVs produced in the U.S., and it was part of the Inflation Reduction Act. And it's expected to be a big tailwind, not just for BrightDrop, but for pretty much every U.S.-based EV manufacturer on the planet, or at least based in the U.S. They have 25,000 reservations or letters of intent for its Zevo electric delivery van, with customers including Walmart, Verizon, and FedEx. So Walmart and FedEx and UPS, and Amazon, they're buying from everyone now when it comes to these last mile delivery vans. So Bram says, hey, Jason, I picked up a few more Tesla shares yesterday. I picked up one more Tesla share. So that means I'm up to like 16 shares that I've grabbed over the last couple of weeks while Tesla's been under $200 a share. I'm getting pretty close to another 100 share block. So that'll allow me to start selling options on that next block. So I'm pretty happy about that. But I have my concerns about Tesla at this point. And like I said, it has more to do with competition than anything else. The consumer, if you wanted to own an electric car, even just a couple of years ago, inside of the United States, your only option was really, the Chevy's Bolt EV or Tesla. And the Bolt it's not a bad car, but it's just not a Tesla, right? It's just not as capable as a Tesla. That's all changing right now. And that's one of the things I wanted to take a look at here. When we're looking at the Hyundai Ioniq 6, I'm sorry, it was a Hyundai Ioniq 6, not the EV6, the Kia, was the new standard in dynamic EV driving, sells out in 24 hours. But this is Electrek, and this is a kind of a famous website that tracks electrification of transportation all over the place. And one of the things you see here is a distinct lack of Tesla news. There's very little in the way of Tesla news on here, and that's not necessarily concerning for Tesla, but it is really an improvement for everyone else that's out there in the EV space. So let me see. VW's strategy to catch Tesla fading with a key $2 billion trend in the EV facility plans up in the air. So I have been seeing a number of EV EVs out there that are not Teslas on the road. And the Volkswagen ID4 is one of those that I'm starting to see pretty much every time I drive to work, which I drive to work kind of like at 2:30 in the afternoon, 3 in the afternoon, generally not during rush hour. So I wonder how many more I would see if I was driving during rush hour. And it's not just Teslas that I'm seeing anymore. It's all kinds of electric vehicles that are out there. Mercedes electric vehicles, a lot of Hyundais, and a lot of Kias that are out there. So Fisker Ocean SUV rather commences production in Austria on schedule, which is amazing. Fisker's been one of those countries that has one of those companies rather that has been talking about EVs forever, but has not really had a lot in the way of deliveries. So American EV automaker Fisker has just hit a major company milestone in the making. Contract with manufacturer Magna Steyr has officially begun of the Fisker Ocean SUV at its carbon neutral facility in Graz, Austria. With Magna's help, the second iteration of the Fisker brand continues to prove naysayers wrong while moving to the delivery a truly unique looking EV. Yeah, it doesn't look unique to me. So, and they haven't proved naysayers wrong yet. They need to actually sell those. So, yeah. Anthony Walker says every time we go up, YouTubers promoting buying the market, and that shows their lack of knowledge. I'm not sure that's necessarily the case. There's rarely a time when I'm not in a buying mood, and that's generally when the market is at its highest and when it's hottest, because it's just difficult to find value. And so let me remind you, the majority of investing that I do is not in technology stocks. That's just the type of investing that is most exciting to me. But the majority of investing I actually do is in really boring ETFs. And I do have a legacy portfolio full of older companies that are out there, S&P 500 companies that are out there, because I worked in the oil industry before, worked in big tech, and those are still in my portfolio. I haven't disposed of those. But particularly when it came to big tech in the last year, it was hard to find anything that was value. And remember, I'm evaluating all of those on a current cash flow basis. And so it was really hard to find value. We're now approaching the point where a lot of these companies that are in solid leadership positions are starting to look like they have value. So, Jason, have you driven a Tesla? My ride in a Model S about 5 years ago blew me away, and I used to drive a 6-speed Camaro Z28. So the only model Tesla that I've ridden in has been a Model 3, and I was less interested in the performance of that because of where I live. You can't really open up a vehicle anywhere unless you drive 2 hours out into the middle of the desert. What I was really interested in was the autopilot capabilities. My buddy who owns the vehicle was actually on one of the pilot programs for one of the new releases for autopilot. And so I got a really good view of what riding in a Tesla was like on autopilot. And let's say it wasn't perfect by any means. Like I think I said before, we missed 2 exits on the freeway because the car will not play chicken. And driving in heavy traffic is always a game of chicken. You turn on your turn signal, you give people enough time to view your turn signal, and then you basically shove your way into that lane and force people to slow down or hit you. I mean, that's essentially what driving is like, or you wait for your opportunity. In really heavy traffic, the Tesla would not force itself into the exit lane, and we ended up missing 2 exits because of that. So, but I mean, the car actually got off the freeway, turned around, got back on the freeway, all that stuff. So all of that worked. It just took us longer to get to our destination than originally planned, and a lot of that was the fault of a lot of it was a fault of autopilot, and I don't see that really improving for quite some time. So let me see here. And so Texas lithium refining project moves to private negotiations in Texas. That is pretty good news. This is actually really, I don't know if you guys know who Peter Zehan is. He's a kind of a global strategist who talks all over the world at universities and things like that. He does a really good presentation. He's been more famous lately because of the things that he's saying about Russia. And one of the things that he's talked about is he says that there's not going to be an EV revolution, that it's not going to happen in its current form with its current technology, largely because of constraint in materials, because Russia controls so much export of cobalt and nickel. This is actually a really good sign, and he may just not be aware of how many other sources of nickel there are in South America, in Asia, outside of China, and how many other sources of cobalt there are. Like the vast majority of cobalt actually comes from the Congo, which is really problematic, but that is slowly disappearing from cathode chemistry, as many companies have realized that relying on something that is so politically and geographically constrained might not be such a smart idea for a business. And one of the things that people have done is gone out and tried to secure new sources of nickel. So GM secures nickel for EV ramp up from Vale's new Quebec factory, Battery Valley factory. So I think you're going to see more and more of this happen. So a lot of countries are underground, huge into mining. Canada is one of those. Australia is one of those. Brazil, and of course, Chile. If you don't know anything about the mining industry, you might not know what large players they are in those industries. And I expect them to really benefit from. What's coming next in EVs. But that is something that is very interesting. That almost none of the news today is about Tesla. And going back quite some time, a lot of it is companies that we know about. Ford fighting electric vehicle bottlenecks with industrial automation giant. Tesla's largest solar panel maker pledges to build a $1 billion factory in Southeast. Toyota is promising a fifth generation plug-in. And I didn't read the article, and we see Tesla sees a drop in buyer interest. Survey says we might know why. Actually, I think I would like to know the reason why. So, Kelly Blue Book released the Brand Watch survey. Company claims it points to plummeted shopper interest in Tesla vehicles. Let's see. What's the reason? Doesn't really give a reason. Interesting. Anyway, I'll probably read this at a later time and take a look at that. When we look at news coming out of China when it comes to the EV market, very little of it is Tesla also. So XPeng unveiled new images filed to their Ministry of Industry and Information Technology. And really the big news on this is going to be the inclusion of LiDAR devices over the existing version. So they're really committing to LiDAR. And this is one of the things that Elon Musk has called kind of stupid. This is one of the things that other engineers at Tesla have claimed is completely unnecessary and unneeded when it comes to self-driving. And so I'm very interested to see how this turns out, or if it could be a giant waste of money. But the pre-sale of the Audi RS e-tron GT kicks off in China. Mercedes-Benz news here, Li Auto news, BYD news. A little bit of Tesla news about deploying 1,300 supercharging stations on the Chinese mainland by 2022. Very interesting. But Voya unveils a NEV architecture ESSA as a first sedan to make its debut in December. So there's a lot of different companies out there that are existing in China that we've never heard of. By the way, Yavu's, I'm not even, Bolo Kobasi is your last name. Thank you very much for the super sticker. And I always appreciate that when you guys do that. Also, I never promote my Patreon in here. I usually just kind of mention that somebody in my Patreon said something. But there's been a pretty active discussion going on in that group right now with what's going on in the crypto world, especially when it comes to the FTX collapse. And having worked at a company, not for the company, but worked at a company as a contractor in the middle of a collapse like that before, I was at Enron in 2000, doing something that was unrelated to the core business that collapsed. But I was there and not told until almost the last day not to come into work because, hey, no one's going to be able to pay you. The best comparison I have to what's going on now is not Bernie Madoff and a Ponzi scheme. And it's a little bit of Enron where it's really just crappy accounting. But with the news article that came out today concerning what the new CEO, who's basically there to dismember the company, had to say, this is uh, like basically putting a pack of chimpanzees in the White House and asking them to run the country. It was a bunch of people that are in their late 20s and early 30s that acted like some really irresponsible teenagers. There was basically zero corporate oversight. I'm not sure how much of the FTX collapse is due to excessive risk taking. I don't know how much of it is due to actual malice or how much of it is due to just not too bright in a lot of ways when it comes to managing money. And I really think it's just sheer incompetence that caused this. And it's probably less malice and more sheer incompetence. Is that they just didn't understand that at some point your books have to reconcile. So, yeah. Let me see here. How much news is just press releases, usually right next to the advertisement for the product? A lot of it is. A lot of it is. And especially when it comes to these newer companies where the only ones covering them are themselves. Meaning, if you go to Moneyline right now and take a look at their if you look at any news on Moneyline, almost all of it comes from Moneyline itself. It's not covered a lot in the media. It's such a tiny company, like doing $100 million, or was they're going to do like $220 million this year in revenue. It's a tiny company compared to other fintechs out there. And I just want to reiterate this. I talk about this stock, but it is an entirely risky, entirely speculative stock. There are many reasons why this company, they might not make it, even though they're showing really good growth. They did have an earnings miss, which I'm not all that concerned with, especially in light of the fact of their revenues increasing and they were continually able to cut costs, and they're approaching that level of EBITDA break even, although they're not going to hit it this year like they originally. They're not going to hit it this year like they originally said. It's going to be later on this year. So, the further I get into my investing journey, the less I'm interested in crypto. Yeah, I've always been, and I've stated this from the very first time I talked about crypto. I'm less invested in crypto as an investment than I am about the possibilities of blockchain technology. The token that trades on the blockchain is not as important to me as what the technology can do. And that's what I find really interesting. And I think that one of the most interesting applications of blockchain to come in the last couple of years is that the government of Ukraine has actually been storing all of the evidence of war crimes on the Ethereum network, largely so they can say, hey, this has been in existence in this time period. It hasn't been altered. These images haven't been altered. This is the story. And it was kind of frozen in time when it was done. That was a usage of blockchain that was unanticipated for me. It's also one that I don't know how that's monetized. I really don't, right? But it's a use out there that I find very, very interesting. And we may see more uses of blockchain that are just not predictable at this point. The idea of investing in a crypto, if you guys notice, I never did a video on what was it, Dogecoin that came out last year. I put $200 in there, doubled my money, and yay, that was fun. But I wasn't betting the farm on that. I kind of realized what the game is with almost all cryptos out there. This is the game with almost all cryptos out there. None of them are substantially different. These are just cynical ways to get something to moon if you can, and to escape while you have all the money. That's all it is. And that would be 99.9% of crypto projects that are out there. There are many crypto projects that are out there that are really good, but they are indistinguishable from the 100 other products that are really good out there as well. The couple of cryptos that I've talked about on my channel have been Algorand, Ethereum, a little bit of Bitcoin, but mostly Algorand and Ethereum, and that's been all about smart contracts. So, it's been all about smart contracts when it comes to that, and all about energy efficiency and that sort of thing. But it says nothing about tokenomics. What I'm talking about is the adoption of blockchain for its transactional abilities and its cross-border abilities, its ability to store value that basically to transfer value without using our current monetary system. And that's what I've been excited about. Not so much about tokenomics, because one of the big things with FTX, and I can't remember the name of the quant trading firm that they tried to start, but the idea that you can have a quant trading system on blockchain right now, I think is kind of silly. The reason those systems work when it comes to stocks is because you can execute a trade in nanoseconds. So much so that people are fighting over real estate in New York that's closest to the exchange, because even though these messages from one server to another travel literally at the freaking speed of light, the shorter you can make that distance between their server and yours, the quicker your trades are going to go through, right? So that's one of the, and this is the thing you cannot do with Bitcoin. It may take 10 minutes for a Bitcoin transaction to settle. And there are a lot of ways that the consensus might not be reached with the network in time for you to benefit from quant trading. Like, the entire idea of quant trading of crypto to me would be very suspicious. And I say this because I already had experience in this way back in 2017, 2018. I had someone who tried to get me into and this is going to sound funny because it is, they tried to get me into a Bitcoin trading scheme where they were trying to say that they had a system to trade derivatives on Bitcoin, when at the time there were no derivatives on Bitcoin. And this was called, I think, USI Tech was the name of the company that was out there. It was a total scam, right? And so they marketed it as a software license and not as trading Bitcoin or trading securities. And they did that in order to get around anyone being associated with trading unlicensed securities, right? But they weren't trading anything. It was just a scam. And I tried telling someone at that time, who I don't know exactly how much he put in there, but I knew that it probably represented almost all of his life savings that was outside of his 401k. But he put all of his money in there. He actually flew out to Dallas to have a face-to-face, and he would make YouTube video after YouTube video on how everyone's going to make money, how this works, and he didn't quite understand that without the ability to verify, and this is the other thing, I tried to tell him too, that based on the volume of trades that is going through their USI Tech, and all of the trades are public on the network for Bitcoin, right? You can actually just look at the volume of trades that's going through. That based on the volume of trades they were saying was going through on their network alone, they would account for every single Bitcoin trade in the world and then some at the time. And the guy just simply refused to believe me. Because he had already made a little bit of money on this, and he kept rolling the little bit of money he thought he made back into the program rather than taking it out. I assume that he ended up losing everything. He just disappeared off the radar, would not answer any of my calls anymore, and I have not heard from him since. But this is not the first time that I've experienced something like this, and it doesn't have to be in crypto. There were other things that I encountered, especially really early in my financial career. I encountered a couple of scams where I could not convince people that they were involved in something that was a Ponzi scheme until the day it collapsed, right? So FTX, not a Ponzi scheme, and not really similar to what Bernie Madoff was doing at all. It looks like these trades were going through. They were just losing money at what they were doing. And borrowing customer funds also to loan out is also not abnormal as well. If you have a margin account, that is what the firm is doing with your stocks. That is what you do when you short sell a stock. You are borrowing stock that you don't have to sell someone at a price where you think it's going to go down. So this is not something that's out of the ordinary, but it all has to be done when you're managed under the SEC rules and rules of the Investment Company Act of like 1933. And Investment Company Act of 1933 or 34, one of those years. It's been almost 100 years since we regulated this behavior when it comes to currencies and securities. It's still not regulated with cryptocurrency. And this is kind of why this happened. It's because there was no record keeping that was necessary at the time, right? It's not necessary. And I think that a large part of what's going on with FTX is never going to be unwound. The money is never going to be found. the transaction trail for these transfers is probably never going to be found. And the evidence that would, a lot of the really damning evidence that would be there when it comes to the communications between uh, people on who work for FTX is probably not going to exist, largely because they use a couple of different apps that automatically deleted messages after quite some time. So, or after a little bit of time. So Hamdad Amadi says, any cheap stocks that you're planning to buy? So I'm really resisting the urge to buy right now some of the picks that I already have a lot of shares of. And those are like, SoFi is one of those. And I'm really trying to stay disciplined and buy a lot of financial stocks. Financial stocks may see a really rough time. And I'm talking about the big financial stocks like, let's take a look at this here. Like JPMorgan, like Max, and Wells Fargo, Bank of America, all of these big players that are really going to benefit. And they benefit in a lot of ways. They're benefiting from increasing spreads between interest rates. You're seeing interest income on their earnings reports increase all across the board, and that's going to continue for years. They set themselves up for greater and greater spreads for years when it comes to their deposit operations. But when it comes to like Citigroup and American Express, which runs Ameriprise, Wells Fargo, JPMorgan, Morgan Group, TD Ameritrade, all of these companies, they're also really going to benefit from the massively increased trade volume that's going to come when the market really does turn around. But also the return of mergers and acquisition deals, the return of companies going public, and really the issuance of debt. We're seeing a huge freeze on the issuance of corporate debt right now. At some point, the market's going to get used to the higher cost of capital and the market, and there's going to be demand for corporate debt that is out there again, especially when we see a lot of these companies that are in poor financial condition really start to shake out. And the big institutional money guys like Morgan Stanley, JP Morgan, Wells Fargo, Citigroup, all these people that underwrite the issuance of bonds, right? All these people that benefit from volume of trading, all these people that benefit from bringing companies public. These are the companies that are going to benefit the most coming out of a recession. This is what generally happens coming out of a recession, is that these financials tend to benefit really early and really well. Not only that, the earnings tend to be kind of sticky moving forward as well, right? And really the what I can't impress upon you enough is it's going to be the underwriting of bonds, and that's going to be big business coming up here in the future. And let's say like a company like Tesla wants to go out and raise, $5 billion with a bond issue. So they want to issue a convertible bond that pays now, instead of a zero coupon convertible bond that you could maybe convert into 40 shares or something like that. It's going to be, a bond at 4% or something like that. So they're going to have, the company has a bottom line of what they want to make from that. A consortium of investors will get together and share all of the risk. So it'll be like Morgan Stanley, JP Morgan, Wells Fargo, all together. They get together and they share the risk of underwriting that bond and they bring it to market. Their profit is made on that day one. They generally don't hold any of that on their balance sheet unless they see that they want to own it, because it might be very, very profitable for them to own it. But a lot of times they just sell all of what they're underwriting. But there are massive fees when it comes to this. The other thing you're going to see, as revenues drop from local municipalities, they're going to go out and borrow more. There's going to be this huge issuance of municipal debt as well. And now that interest rates are higher, those tax-free, because municipal bonds are federal tax-free, usually state and local tax-free as well, you're going to see a large increase in the issuance of new corporate or new municipal debt that's out there as well. And this is all stuff that goes to the bottom line. Companies like SoFi, companies like Moneyline, companies like Square, companies like PayPal, they're all going to miss out on this because it's not part of their core business. It takes a really long time to set that up, and they're all going to miss out on that. It's not to say that there isn't plenty of other business to go around, but this is one of those ways where, buying some of these stocks right now, or buying leaps even. And at this point, usually I tell people to buy like deep in the money leaps. At this point, I'm not even sure I would buy a Wells Fargo deep in the money. I'd buy a year long, out a year and a half, 2 year leap, and maybe even as low as or as high as like 40. Like normally, if I was going to buy a leap, I'd want to do it at like half, right? At roughly half of you want a delta of about 0.8 when you buy a leap normally. And so I'd buy it about half the current value out anywhere from 14 to 18 months. In this case, right now, because of sort of the long prediction of better interest income and higher trading volume with in an area of their companies that's really kind of unexciting but generates huge amounts of income, I would go a little bit less deep when it comes to buying those leaps at that point. Like I'm not sure I'd go as high as 40 with Wells Fargo, but I probably wouldn't go under 35. I probably wouldn't go under 35 for that. So I haven't actually put that down to pencil and paper yet. So don't quote me on that. It's not a recommendation to buy or sell any particular security. But if you've never bought leaps before, now would be a pretty good time. But let's remember, you are not going to really just, in order to get the preferential tax treatment for the leaps as well, you need to buy them out at least 12 months into the future. But not only that, it's remember, you will see red for months at a time before that leap actually, before you're in the money on that leap. Okay. Months and months and months at a time. So, and remember, it's going to be priced a little bit higher than you think because it is an in the money call right now. Right. But what you're really betting on is on that theta value, that time decay. So, yeah. Let me see here. Money line is at 74, surely the bottom. I think it's probably pretty close. And like I said, the earnings didn't look terrible. It is a growth company and it's still steadily growing. And that's what I find very encouraging. Having said that, though, there are a lot of risks when you're that small going into an economy like this. And the other thing I think I've made clear on this is I don't understand everything about their business model. I really don't. So you really have to do your own due diligence on here. And I'm always been like pretty careful about saying, hey, I'm not telling you to go out and buy a certain stock like right now at this price or whatever. But really, if you look at all the big YouTubers out there, like Meet Kevin, Andre Jick, who's the Graham Stephen or Stefan or whatever, all of these guys, man, they were all going out there and they were hawking different cryptos out there that were shit coins last year. A lot of them were pumping FTX. A lot of them were pumping BlockFi and all. And BlockFi, I don't know if they're going to collapse, but the contagion is real. Okay, but a lot of those guys have come to really sort of regret that. And that's one of the things that I'm glad that I don't have anything to regret because I didn't tell you guys to invest in anything. Also, though, I'll have to be fair. They're getting really big offers of money to promote these on their channel. I'm getting offers pretty much on a daily basis, but a lot of it's for stuff that's obviously just ridiculous and really, really, I mean, it's some of it has nothing to do with my channel. Nothing. They want me to hawk products that I would get $5,000 to promote it, even with my small audience, but it has nothing to do with finance whatsoever. And the stuff that does have something to do with finance is almost all crypto related. And it's usually opaque. I can't find anything on what it is that they're trying to promote. And there's no information out there on what it is that they're trying to promote. And the information they give me is not enough to do due diligence in. And that's the reason that I've turned it down, is either I couldn't find enough to understand their product, or what they did provide me was not illustrative at all. And so I've not been able to take the opportunity to do a sponsorship deal like that. And I'm going to be a lot more cautious in doing so. And I'll say one thing though, is that, what was it? The offer of 8% on your money for doing nothing, right? And they're going to turn out and loan it, right? And you know that money is going to be turned out and loan. Like you're putting on their platform, so it can be turned out and loan, right? You do that with a bank, right? You get paid on a risk-free deposit right now, which is what a CD is. Not right now, but let's say it was back in January. A risk-free deposit would have paid you about 25 basis points annually, maybe 50 basis points annually in January, right? Maybe 0.5% annually. And at the same time, FTX is offering 8%. Right. So it's not, if it's FTX, that it's not FDIC insured, it's not really a bank, but they're still saying there's almost no risk in this transaction. There's all kinds of risk in the transaction. If it's over what you get on a CD rate, you have risk. If it's over what you get on the 3-month treasury, there is risk involved, right? The 3-month treasury is what's considered a risk-free investment, meaning the maturity on it is really short, so your interest rate risk is really short. The claims paying ability of the United States is pretty good because if they don't have the money to pay you back, they can just print the money to pay you back. And we can talk about why that doesn't work out for other countries that have dollar denominated bonds, and that's largely because they have bonds denominated in dollars. The dollar is we are in an inflationary period. They still have to pay us denominated in dollars, and they can't print currency to do that, right? So that's one of the things that's out there. So let me see here. Michael says, do you think the S&P 500 will bounce along the bottom until the Fed announces a positive interest rate hikes? I do. I do. I think the market's going to react pretty positively just to a 50 basis point raise if we have that in December, right? I think the market react pretty positively to that. I think there's a lot of different reasons why, though, we could retest the level of about 3,600. I think there's a lot of different reasons, and a lot of those have nothing to do with what the Fed could control. We could have a really bad respiratory disease season this winter, although we're pretty far into it right now, and it doesn't seem that bad, even in China at this point. There could be disruptions to the energy market because of what's going on in the Middle East right now. There could be disruptions to food markets and energy markets as well because of what's going on in Ukraine. There could be one-off events like Russia starting a war with NATO or something like that would really affect the markets. And those are all things that you can't control. But let's remember that the Federal Reserve can only constrict money supply in the United States. Other countries around the world are going to have to or fall in line when it comes to their central banks as well. Otherwise, the Federal Reserve is not going to be able to control inflation. This is a worldwide phenomenon. It is not limited to the United States, and this is a global economy. There's inflation going on in Colombia right now. There's inflation going on in Turkey. There's inflation going on in Europe. There's inflation going on in the places near Europe, like the UK, Australia. Japan seems to be one of the only places where there isn't a ton of inflation, and that's because they are just a low consumption society, right? They're an extremely low consumption society. In a high consumption society with supply chain issues, you're going to see inflation anytime you see supply chain being disrupted. Now, if you look at previous periods of inflation here in the United States, in the last 8 or so, 6 of those were caused by supply constraints, like meaning runaway increase in demand. Only 1 or 2 of those, I'm really talking about 1968 to 1970, before the oil crisis, and I'm talking about 2008, where it's really due to an overheating of the economy that we begin to see price stability break down and rise above that 5% level, right? And those are really, really brief periods. The tools that the Fed had before, which were price controls, didn't really work that well, right? Time is really what solved the problem, and a normalization of supply chains. A lot of it was caused by, hey, the United States is going to war, so now everything is in demand, or all the troops are coming home and everything is in demand. That's really the story of the inflation that we had at the end of World War II, right before the Korean War, right after the Korean War. That's the story of those events, is supply constraint because of that. And then, of course, we have energy supply constraints, which really kicked off a long period of inflation in the 1970s, which was exacerbated greatly by the problem of people keeping physical reserves of cash to back up their currency. There were 72 or 73 different countries in that time period that backed their currency with US dollars, which meant that you had to actually keep large amounts of physical cash in a safe somewhere in your country that represented the conversion rate to a certain amount of whatever the local currency was. You had to keep it in it. So Paul Volcker, by raising interest rates, that was one of his goals, was to break that cycle where these countries are just putting more and more physical currency in their vaults because they had to do it to back their currencies. He wanted them to replace that with government bonds. And that's what he did. He essentially traded high inflation for much greater debt, right? So the government was able to say, hey, rather than keeping $1 billion in cash in a safe, you're gonna buy our government bonds, right? So they'd sell them government bonds, pay them interest on that. That was used to help peg currencies, even though it has a floating value. This is very, very different. We're in a totally different world than what happened in 1982. The only thing that we have in common is that we have inflation. But the interest rate is not the only tool that they have. Selling government securities again is going to be huge on the plate as far as what the Federal Reserve's response is going to be to inflation. I expect that even when interest rates stop, there are going to be massive sales of government bonds, and that's going to raise yields as prices on those bonds drop. They're going to do it not to the point of complete demand destruction, but I think it's going to hurt long-term bond investors like really, really bad. I think that folks that are have bond portfolios of the duration, say under like 7.5 years or something like that, are probably going to fare fairly well. Not well in the immediate, not in the next year or so, but after that they'll fare fairly well. But as the Federal Reserve unloads its balance sheet, I mean, they could essentially be money supply neutral, even as they cut interest rates if they're selling bonds in the open market, right? And they're continually increasing yields by keeping the market relatively flooded with bonds. They could continue to reduce the balance sheet and at the same time reduce inflation, while at the same time making it easier to borrow. I know that sounds contradictory, but that's theoretically how it would work. I don't know that that's theoretically. And honestly, like all the literature that I've read on this, I can't point to a single actual case where that was done. So yeah, let me see here. In the UK, it's been confirmed we are in a recession. Most of we were. Time to pay off any debt and save and invest. Well, so I'm always a fan of paying off debt. I'm always a fan of saving and investing. Okay. And I do that regardless of what the economy looks like. But would I stop investing even if I know we're going into a recession? And the answer is no. I don't know when the market turns around. I don't know where bottom is going to be. No one knows this. Predictions of when a recession happens, predictions of how long the recessions last, where the bottom is, when the turnaround happens, are almost always wrong. And if you live by the crystal ball, you're going to end up eating glass. Right now, I would save whatever you're saving. Maybe I'd pad my savings a little bit more, but I definitely wouldn't stop investing, especially in quality companies. And when I say quality companies, there are very specific guidelines that I want you to that I want to consider when I look at what a quality company is. A lot of that has to do with balance sheet. A lot of that has to do with income projections, current income, but a lot has to do with cash on hand and where they are in the marketplace. One of the best ways to pull a list of good quality companies that you want to invest in is just go look at the top holdings or the complete holdings of the ETF QUAL. I don't know. I can't remember which company runs that, but it's been a great company. It's been a great fund. Mostly what they invest in are companies that have really good balance sheets, have really good low price to earnings ratios, good balance sheets, that sort of thing. And you'd be surprised how many technology companies are on that list right now because they have huge cash reserves. Technology companies, for the most part, have also been investment companies as well. But unlike FTX, these guys aren't dummies, and they've had a difficult time finding value in the last 2 years. There a lot of them, or they invest in new startups, but a lot of time they invest in companies they see as a value that are also sort of like small cap to mid cap range. And I know that they've had a tough time finding value as everything was either fairly priced or overpriced in that near term. So they're sitting on mountains and mountains of cash. Some of that cash gets put into innovation. Some of it gets put into buying innovation, which is what their investment plan is. And they had a hard time finding the right price for the innovation they wanted to buy in the last 2 years. So they're sitting on mountains of cash. Google is one of those. Apple is one of those. Verizon is one of those. Even though I can't stand Verizon, it's actually a good company. But there are, I would look at that ETF QUAL as a good guide as to what stocks I should probably individually look at here. And this is, we'll take a look at this right now. Yeah, so it's iShares Quality Factor ETF, and they have a number of different factors on there that they use to judge sort of a different calculation there, where they are. Let me see here. They don't have their listing down here, but they have a year-to-date return down 18.58%, which is essentially, it's pretty close to what the S&P 500 has done. The beta is relatively low at right what the market is. The expense ratio for this fund is fairly low, and yield is right about what the S&P 500 has. Right? When I'm looking at sort of a 5-year return on quality companies, though, it's pretty close with a little bit less volatility than what the S&P 500 showed. And if you look, there wasn't all that severe of a drop. It went from 100 down to $81 a share or so in the middle of 2020, in the middle of the pandemic. This fund only lost 20%. Funds lost a lot more than that from peak to trough in those first few months of panic, but a lot of this had to do with their quality holdings. So, and at this point right now, where you're seeing another but more precipitous decline here from November of 2021, where it really started, down to now, and this is kind of the last month's rally here, you've seen actually a pretty big drop here, almost a 50% drop in that. In quality. And so I think that's where the value lies right now, is in these quality companies that are out there. If you're watching my channel, you probably already have tons of high risk technology stocks in here. And the technology stocks that are small, that are smaller companies that have huge room for explosive growth. And if you wanted to add at this point and be in a better position 6 months from now, a year and a half from now, something like, I would start looking at the company, and there's going to be a number of them that recover far more than that 50% that this fund is down from its peak. And I think that you guys should definitely take a look at the holdings that are inside of there. So what you do is you go to iShares, go to the website, pull up the fact sheet from Qual, or go directly to the fund's page there, and you'll be able to see a daily listing of all of the holdings in that fund. And don't just go by the top 10 on there. Take a look at all the companies on there, especially the ones you don't know anything about. And there's something called the neglected company phenomenon. And that's something you study when you take the Series 7 exam. That's something you study again when you take the CFP exam. But the neglected company phenomenon, and searching for value and value investing, right? This is a time that value is kind of returned when it comes to quality companies. I'm not talking about value for SoFi or value for Tesla or value. These are companies where we've vastly overpriced their current cash flows, right? We're looking at people that are currently profitable with healthy cash flows, good margins. Are they priced right now in a way that reflects their true value? This quality factor ETF basically would say that a lot of these companies are not. They're either fairly priced or they're underpriced. So yeah. Final question: with FTX debacle, should some of these YouTubers close the channel? For me, they sold some of their viewers down the river. I don't want to say if they should or not. I don't want to say if they should. I mean, that's really kind of a personal decision. But I would be pretty ashamed, man, if I had been hawking FTX like this. Like a number of these YouTubers did. And a couple of them, I watched a bunch of like apology videos out there, and I do feel sorry for these guys as they're sitting on the mountain of cash, $50,000 a month in the way of some of these guys were paid like $50,000 a month for sponsorships. So they're probably crying right now on their mountains of cash. I don't think that a lot of them are really truly all that worried that all of their subscribers are going to leave. I think some of them will. And in the end, their videos are just so slickly done, and they tell you what you want to hear in a lot of cases. They do have really good videos, but they also tell you what you want to hear in a lot of cases, and that gets you clicks. I don't tell you what to hear, what you want to hear. I talk about what I want to talk about, and I let you know what my honest opinion is, which is not winning me a ton of subscribers, guys. But I do this because I enjoy it. So Sheila's Joe says, buying now seems easier than buying when the stock market is booming. How do you find a good price when everything is soaring? Does the strategy change? So one of the things I don't buy when prices are absolutely soaring right? Like Johnson and Johnson is one of those companies that you could buy pretty much at any time, and you know that whatever in 5 years it's going to be worth more. You can't say that about any technology stock, right? Even if I bought Johnson and Johnson today, I'm kind of fairly confident that in a year it's going to be higher than what it is today. I don't necessarily have that confidence at any purchase when I purchase Tesla stock. My time horizon on that always has to be like much, much longer because it goes through long, long, long periods. Like right now, it's down for the year. Tesla stock is down for an entire year. This isn't the first time this has happened to me, right? Where I've been down for years at a time. But now is the time where in the last couple of crises we had, I'd had to happen to be really fortunate and I had a large amount of cash on hand for reasons unrelated to being a good strategist. It just happened to be when I had a deal came through or something like that. This time around, I have a lot less cash to invest because of a variety of different reasons. But basically, I didn't have anything big happen this year, so I have a lot less cash on hand, and I have to be a lot choosier about what I'm buying. I have added a few shares of technology stocks, but the majority of what I'm buying right now is quality stocks, right? And I'm gonna probably buy a few leaps. And those leaps are going to be on companies like Microsoft, right? On companies like AMD or companies even like Nvidia. Like I think an Nvidia leap might be, buying it 2 years out might be an absolutely fantastic moneymaker. But I haven't looked at that yet, so I want to see where those leaps are being priced right now. But no, that's kind of what I'd like to do is buy a little bit more in the way of quality larger companies with very good prospects in terms of future business that have really solid balance sheets that even if they're losing money for the next 3 quarters, they're not under a ton of financial stress, right? So all right, we are approaching an hour, folks, and once again on cue, my voice is starting to get tired. I did want to say thanks again for the others. Don't do it. Do this from getting any. Uh, so go to one of my videos if you can. If you see a link in the description, it's because I actually remember to put a link in the description. There's a couple of good books on there. I don't know if you've ever read them. A couple of them are really, really boring. But security analysis gives you one of the best ways to evaluate a company on its current cash flows to let you know if it's really truly a good value, right? And that's one of the best tools that are out there. And anyway, check out that. Check out my Patreon if you guys like. I will see you next Tuesday. Thank you very much and have a nice weekend. And I won't do next Thursday because, of course, that is Thanksgiving. And I will be cooking all day since my wife is not originally from the United States and does not know how to cook Thanksgiving dinner. I've been doing it for all the years that I've been married. Anyway, I will see you guys next week. And thank you very much for attending again today.